Good afternoon, Wealth Our Way Nation. What is going on? It is your main man, Charles Tank Harris, the founder and chief visionary officer of the financial literacy platform, Wealth Our Way, where our motto is wealth is not only for the wealthy. I want to welcome each and every one of you to episode 120. We are just chalking up the episodes, aren't we? We are going to be talking this week about cryptocurrency. It is cryptocurrency week here at Wealth Our Way. And today's program will just explain a little bit about what this week will cover. It'll talk about the financial hour of power that is going to be remarkable tomorrow night. I'll introduce the guest to you today. But before we get into any of that, I want to do what I always do here at 15 Minutes of Finance and practice the attitude of gratitude and say thank you to each and every one of you who are here with me live as I stream across the Wealth Our Way Facebook and YouTube platforms. I want to give the Wealth Our Way Nation salute to all the many members of Wild Nation who watch this program overnight, over the weekend on a pre-recorded basis, wherever they can squeeze 15 minutes of financial literacy in, and a heartfelt how are you to the good folks on the Life 101 platform who listen to the audio recording of this very here program. So it's been an interesting few weeks, 4 to 6 weeks in the cryptocurrency space. I believe we saw Bitcoin hit a high that was somewhere in the 60s, only to drop down below 40. I want to be very consistent with what I tell people here about cryptocurrency. So I'm going to repeat what I've always said. One of the things that I guess I'll use the word brag. One of the things that I will brag about is the consistency in my messaging. When you decide to make a broadcast that is going to be permanently just emblazoned across the internet for anyone to go back and listen to a previous episode, you better be consistent or you will lose credibility immediately. If people go back and say, oh, he flip-flopped on this particular topic, he used to say this and he says that. Now, I'm not saying people are not welcome to change their mind. In fact, change is the only thing that's a constant in this world. But you have to be able to say why you feel this way today versus what you felt then. But I have consistently held that cryptocurrency is a new asset class. And I've explained what asset classes are, but I'll take this opportunity to explain it again. When you are choosing to make an investment, you have different asset classes that you can invest in. An asset is something that you can purchase, put your money into that should grow in value over time. We have historically known of the asset classes, stocks, bonds, commodities, and in commodities, we talk about things such as gold, such as oil, things that are physical items that are used throughout the world. These are asset classes that historically we have invested in on a high level. You know, if you have a 401k and you buy mutual funds, your mutual funds invest in stocks, bonds, commodities. They hold cash. And we'll do a whole week of investings where we'll go back, investment information, we'll go back to like Investing 101 and better explain these things to you guys. Cryptocurrency is a relatively new asset class. And one of the things that I've constantly told you guys about here at Wealth Our Way is that I went to school, I graduated with a bachelor's of business administration in finance. But while I was finding my way through college, I also had actuarial science as a major, which is the mathematics of insurance. I used to tutor in statistics. I'm a very math-driven person. And in mathematics, especially in statistics, we trust what numbers tell us, especially there's a rule, it's a law, the law of large numbers. The more data we have, the more trustworthy the information is. We can see something happen one time. We can't predict or project that one-time occurrence will happen over and over again. But if we see something happen a million times, there is more reliability in the projection and prediction that will occur that way moving forward. Cryptocurrency does not have the track record of the bond market, the stock market, the commodities markets. As a result, we don't trust it yet. Or I should say, I don't trust it all the way yet. I keep one eye on it. But the reality is there's a lot of things that I don't trust that I have to interact with and deal with and choose to deal with on a daily basis. There's a acronym that's floating around in the new investment online space called FOMO, 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 fear of missing out. A lot of people are buying cryptocurrency because of FOMO. They have a fear that if they don't buy it and it takes off and goes through the stratosphere, that they've missed a once in a lifetime opportunity to make themselves rich. I've always said that I'm, sometimes the financial party pooper. I'm sometimes the financial dull guy, because I'm never coming on here telling you how to get rich tomorrow. I'm never coming on to this program telling you how you're going to make 50 and 60% returns, although people are making 50 and 60% returns. What I'm going to tell you is how to be more predictable with the returns that you're going to make. So without blowing your mind completely, I'll introduce a term to you in investments that measures the risk of your investments. It's called standard deviation. So standard deviation, you think of the word deviation first and standard second. How much does something deviate from the standard? And deviate means differs, how much it goes one way or another way. So when we set a standard and then the standard that we've set doesn't get met and there's a deviation from that standard, that's risky. We have set the standard. So I'll use the S&P 500, which is an index that measures the general American stock market for large companies. We expect that the S&P 500 will give us a return on our investment if we have chosen to reinvest all of our dividends and short-term capital gains. We expected that return to be somewhere around 10% a year. 10% a year. When we have a year where we get a 6% return, the standard deviation's off 40%. We're 40% to the bad. If we get a 15% return, the standard deviation is 50% to the good. We track and measure that standard deviation, and that tells us what the level of the risk is. And that gives us a comparison point. So I'm trying to tell you high level investment terms, but break them down very low so that everyone can follow this. The stock market has been around so long that we get comfortable with those fluctuations. In 2008, when the market lost 40, 50%, some people panicked because some people have a very short-term perspective, but most people said to themselves, it will come back. It's done this before. We can look in the past and see where it's lost 40% and it's come back. That ability to look back over that track record gives us comfort. And that comfort allows us to follow our investment principles. I give you all of that background to talk about cryptocurrency. It doesn't have the same track record. Because it doesn't have the same track record, it's very hard to be comfortable when we see substantial fluctuations in value. When we don't have a level of comfort, when we see substantial fluctuations in value, it makes us uncomfortable and it makes us not follow our plans that we set out for ourselves. What we're going to cover this week in building your ideal portfolio is to not focus so much on what cryptocurrency is, although we're going to spend a lengthy time in the program tomorrow, Wednesday, tomorrow, talking about it. It's more so about following the basic fundamentals of building any investment portfolio. It's building a solid plan that you don't deviate from. See, you can't control the market. You can't control the assets you invest in. You can control you. I've said this before on my program. Within the first year of me becoming a financial professional back in 1998, I read a study by Dalbar and Morningstar. And the study was called Investments Do Well, Investors Do Not. And the premise behind the study was that the markets don't change. The markets go up and down. They're good, they're bad, and they're always going to be such. However, how we behave in those markets is what matters. Whether or not we choose to do what we said we were going to do. And that is how you get long-term sustainable returns. You get long-term sustainable returns by making sure that you do what your plan tells you to do. So we're going to talk about not only building the ideal portfolio. We say goodbye to Martha.
No, I'm coming back.
We're not only going to build the ideal portfolio, we're going to talk about how much of your money should be dedicated to an asset class. And when I talk to my clients about cryptocurrency, it's a very small slither of their overall portfolio because we are still finding our way. Anybody who takes all of their investable money, throws it into Bitcoin, Ethereum, or God forbid, any of the lesser known cryptocurrencies, you guys deserve what happens to you. If you become an overnight millionaire, you deserve it. You took a lot of risk, and the reward should be commensurate with the risk you took. If you lose every penny of your money, you deserve it because you took a lot of risk, and a lot of risk sometimes doesn't work out. We're going to teach people the DARE. I have an acronym that I've created. I shouldn't say I created. I basically took information that I have gleaned over my years of financial services knowledge and put it into a system called DARE: dollar cost averaging, asset allocation, rebalancing, keeping your expenses low, DARE. And I wrote a white paper called Dare to Be a Great Investor. There is nothing sexy or flashy about investing. There is only consistency and discipline. It is the very same thing about my struggles with weight loss. I know exactly what I need to do to be 225 pounds. I do not get up each day and choose to do it. I can teach you exactly what to do to build a portfolio that will guide you through retirement and leave money for your next generation to build generational wealth. It will be up to you to do it. We are going to discuss the cryptocurrency side of things this week with three very, very well-versed people who know a ton more about cryptocurrency than me. My guy, Chad Copeland, my guy, Devlin McConaughey, and my last guy, Jimmy Williams. So Jimmy Williams, I'll tell you briefly about each of these guys. Jimmy Williams is partners with Corey. They run Buy the Hood. If you've ever had a chance to listen to Buy the Hood, these two brothers are talking about the importance of reinvesting in the communities in which we come from. Their basic premise starts on real estate, but they're both brilliant and they expand outside of real estate. They, like myself, like I'm a stock and bond guy. I got my start in brokerage, but I quickly realized to build a diversified portfolio for ourselves, we have to think more than stocks and bonds. We have to think real estate. We have to think cryptocurrency. We have to think businesses. We have to think savings. We have to think things that are outside of maybe the core of what we focus on, but we stay true to our core. Their core is real estate, but they're brilliant and they've expanded their investment knowledge into other areas as well. Then you have my man, Chad Copeland. Chad runs his brother's company. His brother is Brandon Copeland on the Atlanta Falcons, clients of mine. He runs the day-to-day operations of the Copeland Advisory Fund, the group. And as a result, he's very well-versed in all business areas, but he was one of the early people to spend a great deal of time focusing on cryptocurrency and the understanding the technology behind it and understanding how to extrapolate value and growth out of it. And then lastly, my man, Devlin McConaughey. I met Devlin, almost 20 years ago now. Devlin was creating what we all use in our cars now. When we look in our cars right now, we have basically computers in our dashboard. Devlin met one of my clients who was in the NFL on a golf course and approached him about creating something called ICE, in-car entertainment. And in-car entertainment was basically a computer in your car. It had a hard drive. It did all of these various and different things. But he was a single young kid at the time. He was in his 20s, and he didn't have the capital to build what car companies were able to do. So car companies basically did what Devlin said should happen. One of the smartest, most technical sound guys that I know. Of course, when cryptocurrency hit the streets, it was a new technology. It enamored him, and he has learned so much about the cryptocurrency markets and cryptocurrency investment assets that having the three of them in one place at one time is an absolute delight and treat for you guys as an audience. So we'll be on here tomorrow night for 1 hour talking to these guys. We're going to talk about the actual invention or creation of the cryptocurrencies. We're going to talk about how they can affect you financially. I'm going to talk about building investment portfolios, and we're going to talk about things such as NFTs, field, all kinds of stuff. Data mining. I'm not going to sit here and pretend that I'm the crypto expert. They'll be on tomorrow. We will discuss all these things. So make sure you are here tomorrow. We are at 6 p.m. tomorrow. And my guy made me a great thumbnail. My man, Zach, who also created the banner you see now. I got my logo fixed, Brew. I told you, thank you for the recommendation. We will be here tomorrow from 6 to 7 talking all things cryptocurrency. So please join us. And remember, wealth is not only for the wealthy. I'll see you tomorrow.